All right, what is a preferred return? What does that even mean? What's in it for me? How is that broken down? I'll be going over that in this video right now. Okay guys, so preferred return. This has something to do with apartment syndications, typically. So what a preferred return means is that if you, for example, were an investor, okay, and you were going to put, let's just call it $100,000 into a big apartment complex that a syndicator, also called a manager, you know, they're managing this asset. They're basically pooling your money and lots of other investors' money to purchase this asset, you know, for $5 million or whatever, and have some renovations on it. And then what they're saying is that, you know, they're going to collect cash flow, they're going to increase the value on the property, raise the rents, do whatever things to it, or just it's day one ready. Lots of scenarios for this, for apartment syndications. But what they say is, you know, before they do a profit split, they're going to give you a preferred return. It's not a guaranteed return, right? That this asset still could underperform and not perform at all. There's risks in real estate. But if it does, and you know, the likelihood, according to their due diligence, they're not going to take a dollar of profits, you know, whatever the split is, until you get a preferred return. So let's say it was a 6% preferred return, and this property had a certain NOI, and according to your prorated share of how much equity you put into this property, your 100,000 would get a 6% return before any split came to pass, and it's per annum. So let's say the deal only makes, according to your prorated share, $5,000 that first year. Well, first off, you're due $6,000, right? According to the 6% pref. So you have a deficit of $1,000. Okay? So that could happen. It does if it's typically a big heavy reno the first year and lots of stuff. There might be an operational deficit or deficiency. Anyways, that would just carry over into the next year. So year two, you would be due again $6,000 plus the deficit. You'd be owed $7,000. But let's say the second year it produced a $10,000 according to your prorated share. So obviously you would get your $7,000, then there's $3,000 above and beyond the preferred return, then that would just be split whatever the ratios are between the manager and investor, whatever that is in the agreement, okay? Above and beyond that. So that's what a preferred return means. It just means before the manager takes a dollar of profit shares, he's basically saying like, I won't take, it's basically saying like, I don't feel good as a manager. I don't feel like I've done my job well enough until you get 6% preferred return. Then I'll start dipping into the profit shares for all the work I've been doing on managing this asset, managing this apartment complex, making it better and all of that. Okay, so it's basically just like a way to kind of hedge like, hey, you're at least gonna get a pretty good lion's share of a return, a pretty decent good return, whatever it is, before the manager takes anything. Okay, it's kind of a great way to incentivize the manager and a great way for the manager to kind of put his money where his mouth is, to really state like, hey, you know what, I really want to make sure you get a good return before I take anything. So that's kind of what a preferred return is. Some syndication deals have a preferred return, some don't. Some just have a straight 90-10, 50-50, 80-20 manager and investor split according to the shares. Some do. So just something to kind of think of and to kind of be aware of when we say preferred return. It has to do with multifamily syndications. And yeah, there you go.